Mark's message pops up in the chat. Crude oil's breaking out. I just went full size on CL futures. Stop loss is mental, not getting shaken out this time. I've seen this before. The Discord feed is buzzing. Mark's screenshot shows a clean breakout above resistance. Half the room is cheering him on. The other half stays quiet. The green candle stretches higher. Then, in real time, it snaps back hard and drops. Silence from Mark. 2 long minutes pass. Finally, it's just noise. Adding another contract. The price keeps sliding. Stopped out. Down 14 grand. This was supposed to be the one. Most traders think the difference between that win and that loss is the magic entry. The perfect breakout line. The right moving average setting. But after 15 years of trading and studying behavioral finance, I've learnt the real danger is something else. It's not just that Mark's entry was bad. It's that his whole approach ignored the levers that decide whether you survive in this game. Diversification, position sizing, time horizon discipline, and knowing exactly how much risk you can stomach before you pull the plug. Today, we'll walk through what really happened in that trade, step by step, so you can spot these traps before they gut your account. And I'll show you how professional trend followers think, so you can build systems that survive more than one bad morning. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. And for the next few minutes, give your trading psychology your full attention. There's a book I wish Mark had read before that trade. It's called Following the Trend, Diversified Managed Futures Trading by Andreas Clenow. In it, Clenow shares something most traders don't want to hear. The difference between survival and blowing up isn't the perfect entry. It isn't the secret indicator. It isn't even getting the trend direction right every time. It's the big levers you control. Diversification across markets. Sizing positions by volatility, not by gut feel. Choosing a time horizon and sticking to it. And knowing your personal risk ceiling, the point where a loss feels bad but doesn't force you to abandon the plan. Clenow's message is clear. If you focus on these, you can build a system good enough for a hedge fund. Ignore them, and you'll end up like most retail traders. Chasing wins until the losses chase you. Watching Mark in that Discord chat, I couldn't help but remember my own version of that trade. It was more than a decade ago. Back then, I thought the key to success was dialing in the perfect entry signal. I spent hours tweaking my moving averages, testing breakouts, adding filters. I was convinced the right setup would finally make me consistent. One morning, I spotted what I thought was my golden ticket. Gold futures were breaking above a level I'd been watching for weeks. I went in heavy, way too heavy, because I was sure this was it. At first, it worked. The position was up big within the first hour. I felt brilliant. But then, the price stalled. And instead of taking profits or scaling out, I told myself, it's just a pullback. It wasn't. By the end of the day, I'd gone from a large, unrealized gain to a painful loss. And here's the worst part, I did it again the next week. Different market, same mistake. I was so focused on when to get in, I ignored the bigger picture. My position size was reckless. I was trading one market at a time. No diversification. I had no real idea how much risk I could handle emotionally before I'd start making bad decisions. Looking back now, it's obvious why I kept blowing up good trades. It wasn't the market conspiring against me. It was me. When you size too big, every tick against you feels personal. When you only trade one or two markets, one bad day can wipe out weeks of progress. And when you haven't defined your own pain threshold, you'll always bail on your plan the moment it matters most. That's why I resonated so much with what Clenow teaches. He doesn't glamorize calling tops and bottoms. He focuses on the things that actually keep you in the game. And that's the difference between my old self and how I trade today. I still have losing trades, plenty of them, but I no longer let one morning undo months of work. Because my edge isn't in finding the perfect moment to get in. It's in having a system that can take a punch and keep moving forward. So here's where we're going today. We're going to pull apart Mark's crude oil trade, piece by piece. We'll match every decision he made with the real forces that drive long-term success, the ones most traders overlook. We're going to talk about why focusing only on entries and exits can be a slow form of account suicide, and how professionals flip that focus, putting risk, diversification, and time horizon first. By the end, you'll see exactly how to apply these principles in your own trading. And you'll have a framework that doesn't crumble the first time the market turns against you. This is educational and for entertainment only. I'm not here to tell you what to buy or sell. I'm here to help you think like a trader who can survive, not just until the next win, but for years to come. If I had to sum it up in one image, trading without diversification, risk sizing, and a defined time horizon is like setting sail with one oar in the water. You might move forward for a while, but the moment a storm hits, you'll spin in circles until you capsize. Mark thought his breakout was the wind in his sails. But without the other oar, without those big levers in place, all it took was one reversal to knock him completely off course. That's the reality we're going to explore right now. Back in the Discord chat, Mark's typing again. He's scanning the charts, looking for his next revenge trade. And I can already see the pattern. Every single market he trades is energy related. Crude oil, natural gas, heating oil. On the surface, that looks like diversification, different tickers, different contracts, but they all move to the same song. When energy tanks, they tank together, and when it rips, they rip together. That's the first big miss I see in most retail traders. Diversification isn't about having a long watch list, it's about holding positions that don't all rise and fall with the same tide. Clenow makes this point clearly in Following the Trend. Run a trend-following system on a single market or a single asset class, he says, and you're either being silly or suicidal. Because one sector shock can wipe you out. Think about it this way. If all your trades are in tech stocks, you're not diversified. If all your trades are in crypto, you're not diversified. If all your trades are in energy, you're not diversified. When markets panic, correlations spike. A study by Longin and Solnick looked at international equity markets and found that during large downturns, correlations jump dramatically, from around 30% to over 70%. In plain English, in a crisis, everything starts moving together. That's when fake diversification gets exposed. I remember mentoring a trader years ago who had what looked like a mixed portfolio: gold, silver, platinum. Different metals, right? But they all tanked together the moment the US dollar spiked. He learned the hard way that diversification has to be across sectors, across asset classes, and ideally across geographies. Mark didn't have that. He was leveraged into one theme: energy momentum, without a hedge, without an offset. So, when crude turned, every position in his mental playbook turned with it. The psychological trap here is subtle but powerful. It's the illusion of safety. You look at multiple charts, you see different tickers, and you think you've spread your risk. But if you haven't looked at the correlations, you're betting the same hand over and over. Here's what I tell traders in this situation. List out every market you trade. Next to each, write down its main driver: oil prices, interest rates, the US dollar, equity sentiment. If you see the same driver listed 3 or 4 times in a row, you're not diversified. A truly diversified trend-following portfolio might have energy, agriculture, metals, currencies, bonds, and equity indexes with multiple markets inside each sector. That way, when one sector is chopping sideways, another might be trending. When one is in drawdown, another might be rallying. It doesn't eliminate losing trades, nothing does, but it gives you more ways to win and more buffers against total wipeout. Mark didn't see that. And that's why, even if his crude oil breakout had worked, he would have just piled into another energy name next. Same driver, same risk, same ending. Diversification isn't glamorous. It doesn't give you the rush of hitting a home run trade, but it's what keeps you from striking out and ending the game early. After that crude oil loss, Mark's next message hit me. Going to size up next time. Got to make it back fast. That's the danger zone. Not just emotionally, but mathematically. Mark's full-size crude oil trade was already too big for his account. When it moved against him, the loss wasn't just a number, it was a wound. And the deeper the wound, the harder it is to think clearly. Clenow is blunt about this in Following the Trend. Without a decent position sizing formula, it doesn't matter how good your trading rules are. You can have flawless entries and exits, but if you size too big, you'll blow up. If you size too small, you'll never move the needle. The pros don't size positions based on how confident they feel. They use volatility-adjusted sizing. One popular way, the ATR method, sets position size so that each trade risks the same percentage of capital, regardless of market volatility. If crude oil is swinging wildly, you take fewer contracts. If bonds are barely moving, you take more. That way, each position has roughly the same impact on your portfolio, win or lose. I'll give you a real-world example from my own trading. Years ago, I had 2 positions open, one in wheat futures, one in S&P 500 futures. Both looked like good setups, but I sized them based purely on my conviction. The wheat position was small. The S&P 500 position was huge. Guess which one worked? Wheat took off. S&P chopped sideways and stopped me out. I made peanuts on the winner and lost big on the loser. Not because of the market, but because of my sizing. There's a behavioral finance term for this, overconfidence bias. The more certain you feel, the bigger you bet. And the more certain you feel, the more blind you are to the fact you might be wrong. Mark fell right into that trap. His confidence in the breakout led him to size up beyond his comfort zone. When it reversed, he froze. He had no mechanical exit, no predefined loss limit. The loss just kept growing until he couldn't take it anymore. Here's the thing. If he had sized that crude trade using volatility-adjusted rules, the loss would have been manageable. Annoying, yes, but not catastrophic. And psychologically, he could have shrugged it off and taken the next signal. Instead, he's now in recovery mode, the most dangerous state a trader can be in. That's when revenge trading shows up. That's when risk rules get thrown out the window. That's when accounts implode. Position sizing isn't exciting. It's not what gets clicks on YouTube or likes in the chat room, but it's the oxygen mask for your trading account. Without it, you won't survive long enough to let your edge play out. So if you take one thing from this lesson, let it be this. Your position size is not about how much you want to make. It's about how much you can afford to lose, financially and emotionally, without abandoning your system. A few hours later in the Discord, Mark's back. He's watching the same crude oil chart. This thing is going to rip back, he says. I'm getting in for a quick scalp. That's the 3rd position he's taken in the same market, in the same day. Different time frame, different plan. Same emotional driver. Here's the problem. His system, if you could call it that, has no fixed time horizon. 1 minute he's chasing an intraday scalp. The next he's talking about holding for the big move. It's whatever fits the emotion of the moment. Clenow warns about this. Trend following is about targeting a specific part of a move, often the middle, and sticking with that plan. If you want to capture 1 to 2 week trends, you trade for that. If you want to capture 5 to 8 week trends, you trade for that. But you don't bounce between them just because you're bored or frustrated. Without a defined time horizon, every market wiggle looks like a call to action. And that's how traders overtrade themselves into exhaustion, both financially and mentally. I used to do the same thing. I'd build a strategy to catch multi-week moves in currencies. But after 2 days of sideways action, I'd flick to 5-minute charts just to find something to do. 9 times out of 10, that short-term trade would be in the opposite direction of my longer-term bias, and it would stop me out. A study from Barber and Odean looked at over 66,000 trading accounts and found that the most active traders underperformed by more than 6% annually compared to the least active. Why? Because constant switching erodes the very edge your system is built on. Mark's crude oil trades are a perfect case. If his plan had been to ride a medium-term trend, today's intraday chop wouldn't have mattered. He could have ignored it and let the position develop. If his plan had been for a short-term scalp, he'd have taken his quick hit and stepped aside. Instead, he's caught in time-frame drift. And time-frame drift is a killer because it's often invisible until you review your trades later and realize none of them matched your original plan. This is where discipline isn't about willpower, it's about design. Your system should define your time horizon before you even place the trade. That means your entry, your stop, your target, and your exit rules are all built for that horizon. If the market moves against you inside that window, so be it. If the market moves in your favor, you don't cut it early unless your rules tell you to. Mark's lack of horizon discipline meant that every tick felt like a reason to act. And acting without a clear horizon isn't trading, it's reacting. The market twitches and you jump. The result is death by 1,000 cuts. Time horizon discipline forces you to think bigger than the next candle. It forces you to let the probabilities work over a series of trades, not just one. And it keeps you from chopping yourself to pieces in the noisiest part of the market. By the end of the day, Mark is quiet. Not because the market's closed, but because he's tapped out. 2 losing trades, 1 break even, and a lot of stress. In the post-market chat, he finally admits it. This was too much for me. I can't take another day like this. That right there is the final piece, knowing your personal risk ceiling, and agreeing to it before you even open the first trade. Clenow talks about this in Following the Trend. The higher the risk you're willing to take, the higher the return you might get. But there's always a trade-off. The wrong risk level isn't just uncomfortable, it's destructive. Here's the key. It's not enough to pick a percentage risk per trade. You also have to be honest about the drawdown you can live through without pulling the plug. Because if your system can experience a 20% drawdown, but you can only emotionally handle 10, you'll quit halfway through, right before the edge has a chance to recover. I've seen this happen with traders who run great systems on paper. The backtest says they'll have maybe 1 or 2 10% drawdowns a year, but the first time they hit it in real life, they bail. They cut size, skip signals, or stop trading altogether, locking in the loss instead of letting the system work. There's a behavioral concept called loss aversion. The fact that losses hurt about twice as much as equivalent gains feel good. That means your tolerance in theory will always feel higher than your tolerance in reality. When I first went full-time, I thought I could handle a 25% drawdown. On paper, I was fine with it. Then I hit a drawdown of just 12% and felt like my stomach was in a vice. That's when I realized my true ceiling was lower. So I reworked my sizing and my portfolio until my worst-case drawdown was in that comfort zone. It made me less aggressive, but it also made me consistent. And, in the long run, consistency wins. Mark never set his ceiling. His crude oil trade was a double-sized position in a high-volatility market. Even if he'd won, it would have reinforced the wrong behavior. But losing at that size? It put him right at his breaking point on day one. Here's the takeaway. If you want to survive in this business, your risk level has to match both your numbers and your nerves. That means running the math. What's the maximum drawdown your system has historically hit? Then running the reality check. How much of that could you actually live through without flinching? The market will test that ceiling. And if you set it too high for your temperament, you'll break. If you set it too low, you'll smother your returns. Find the middle ground, and you give yourself the best chance to stay in the game long enough for the edge to pay off. Everything we've covered so far, diversification, position sizing, time horizon, and risk level, isn't just theory. It's been tested, measured, and proven in both research and real markets. Let's start with diversification. In 2012, the National Bureau of Economic Research published a paper showing that during market crises, correlations between asset classes spike dramatically. That means your different trades suddenly start moving in the same direction. It's why holding 10 different tech stocks in March 2020 still felt like holding one big position. On position sizing, there's decades of work behind volatility-based methods. The ATR sizing approach that Clenow uses is rooted in risk parity principles, where the goal is to balance each position's impact on the portfolio. Research from the CFA Institute found that volatility-adjusted position sizing improved risk-adjusted returns in trend, following strategies by over 20% compared to fixed contract sizing. Time horizon discipline also has clear evidence. A study by Barber and Odean, tracking more than 66,000 brokerage accounts over 6 years, found that the most active traders underperformed the market by 6.5% annually. Why? Frequent timeframe switching killed their ability to capture the full potential of their chosen edge. And then there's risk-level agreement. The concept is baked into modern portfolio theory and stress testing. Even if a system looks profitable in backtests, most traders can't live through the drawdowns without breaking their own rules. Clenow emphasizes this because it's where the numbers and psychology collide. Ignore either side and your system will fail in live trading. If you want market history proof, look at the February 2018 volatility spike. The VIX exploded from 17 to 50 in a matter of days. Traders who were over-leveraged in volatility-linked ETFs like 14 saw the product lose over 90% overnight. That wasn't bad luck. It was ignoring volatility, correlation, and position sizing all at once. Or take oil in April 2020. When crude futures went negative for the first time in history, traders who were concentrated in energy with oversized positions had no exit. Margin calls hit instantly. Accounts were wiped out, not because they were wrong on direction forever, oil did recover, but because they had no buffer to survive the storm. The patterns repeat. Markets change, instruments change, but the failure points stay the same. And every one of them ties back to the principles we've just covered. When I look back at Mark's day in the Discord chat, I see 3 psychological traps at work, and they're the same ones I've seen sink traders over and over. First, loss aversion. It's wired into all of us. Losses hurt about twice as much as equivalent gains feel good. Mark's crude oil trade wasn't just a loss, it was a loss big enough to trigger panic. Once that pain kicked in, his focus shifted from following a system to getting back to even. That's when his process went out the window. Second, overconfidence. The bigger his conviction in the breakout, the bigger his position. This is the illusion of control in action, the belief that the more certain you feel, the less chance you could be wrong. In reality, market outcomes don't care about your confidence level. Sizing up based on emotion almost always magnifies losses. Third, process versus outcome confusion. Mark judged each trade as good or bad purely on whether it made money. That's dangerous. A losing trade can still be a good trade if it followed the rules of a solid system. A winning trade can still be a bad trade if it broke all the rules. But in the heat of the moment, most traders let the last outcome dictate their next decision. All 3 of these traps are amplified when you're glued to the screen. Every tick becomes a referendum on your skill. Every loss feels like a personal failure. And every win feels like proof you've figured it out, until the next loss flips the script. The solution isn't to try to remove emotion completely, that's impossible. It's to design a system that makes emotional interference irrelevant. That means risk limits that keep you from panicking. Position sizing that keeps any one loss manageable. And clear rules that tell you exactly what to do so you're not making it up in the heat of the moment. Let's make this simple. Here are 2 tools you can use right now to avoid Mark's mistakes. First, build a diversification checklist. Before taking any trade, write down the market driver behind it. Oil prices, interest rates, US dollar strength, equity sentiment, whatever it is. If more than 2 of your open positions share the same driver, you're not diversified. Either scale down or switch to a market with a different driver. Second, keep a risk log. Every time you take a trade, note 3 things. How much capital you're risking in dollars, how much you're risking as a percentage of your account, and how that position size compares to your volatility-adjusted target. This forces you to see, in writing, if you're oversizing before the trade is live. Both of these tools slow you down just enough to break the react now impulse. They shift the decision from emotional to intentional. You don't need new indicators. You need a process that keeps you from breaking your own rules. And these 2 steps will get you there faster than any tweak to your entry signal. Before we wrap up, I want you to think about your own trading. If your top 3 trades this month all moved in the same direction at the same time, were you really diversified? If one losing trade could make you abandon your plan, is your position size too big for your nerves? If you keep switching between scalping and swing trading, do you have a true time horizon, or are you just chasing action? And if you hit your system's worst-case drawdown tomorrow, would you have the discipline to keep trading it? Be honest with yourself. Because the market will test every weak spot you have. And it's better to find those weak spots now, on paper, than to have the market find them for you, with real money on the line. So, what did we learn from Mark's day in the Discord? That the market doesn't punish you for bad entries, It punishes you for ignoring the big levers. Diversification, position sizing, time horizon discipline, and knowing your true risk ceiling. These are what keep you in the game. Ignore them, and even the best-looking setup can take you out in a single morning. Now here's my challenge to you. Write down the single biggest takeaway you got from this video in the comments. Share it with a friend who's been struggling with their trading. And if you found this useful, like, share, and subscribe. Every trader you've ever admired had to master these same principles. And the sooner you make them part of your own process, the sooner you trade without fear of the next big loss. Master your mind. Master the market. Trade with confidence and live with calm.